and welcome to our virtual market update event. And it wouldn't be a virtual update without some technical difficulties, so thank you everyone for waiting for us. My name is Lindsay Zubek, and I'll be your host for today. Before we begin, I'd like to acknowledge that I'm speaking to you here today from the Coast Salish Territory, represented by the Musqueam, Squamish, and Tsleil-Waututh Nations. They've been custodians of this land for thousands of years, and I'd like to pay my respects to the elders, both past and present. First, some housekeeping items. If you're interested in referring to any of the information we talk about today, no need to take any notes, as we'll be recording the session and sending you a link afterwards. Also, you are all on mute, so please don't worry if there's any background noises from where you're listening and watching us today. Like I mentioned, my name is Lindsay Zubek. I'm the manager here at VCIM, which stands for Van City Investment Management. We'll try not to use too many acronyms today. And I manage our awesome team of discretionary portfolio managers. You know them better as Gianni, Elise, Rakesh, Howard, Naji, Jordan, and Naslin, who've all invited you here today. I also manage our financial and estate planning teams, who would put together your free comprehensive financial plans and also provide you with important estate planning advice. It's a privilege for me to work at Van City and at VCM with such an extraordinary team of individuals who I learn something new from every day. We are all so excited to be here today. This session is not only to provide you with an economic update, but also to introduce you to the machine and the brains behind our investment operation. We work in very much a team-based environment. Your discretionary portfolio manager works very closely with our investment management teams. That's our equities team, our fixed income team, our ESG team, and I should say our ESG team is our environmental sustainability, social responsibility, and corporate governance. And they all work closely together to make sure that we're doing the right things for you and your money. Today, we're going to introduce you to our equities team, led by Marc Sheard. Marc and the team will go through a market update. We'll have a Q&A session with Marc's team, and also someone from our fixed income team, Wes Dearborn, one of our portfolio managers, and someone from our ESG team, Edmund Ho. So we'll be able to answer questions from any area that you might have interest or questions in. We'll keep an eye on the time and wrap up and send you on your way by 3 o'clock. Please feel free to type in your questions at any point during the presentation into the Q&A box, and we'll do our best to get to as many of your questions as we can. And before I hand it over to Marc, who will introduce himself as well as his team, and Marc's going to tell you all about his professional experience and the incredible things that he's been doing here at VCIM. But what he might not tell you, which is a fun fact about Marc, is that he was an avid skier and spent time skiing and living in Banff before his professional career started. And I think that's what they call a ski bum, Marc. Without any further ado, over to you, Marc.
Thanks, Lindsay. So I just want to say how happy we are to be here. I wish this was in person, of course, and hopefully next year it will be, but it's still nice to be able to introduce the equities team to everyone, provide an overview of what's happening in the market, and just answer any of your questions. And I first just want to say that each of us understand the responsibility that we have been given in terms of ensuring we get the best possible returns that we can for each of you, and we take it very, very seriously. We're also invested alongside you. We have friends and family that have invested a part of their net worth. So, we're very well aligned. So I'll start off with a brief overview of the equities team, which has expanded quite a bit, with 4 of us joining Van City in just the past 12 months. I'm personally just coming up on my 1-year anniversary. And when I first started, Jeff Adams, who's the director of VCIM, and we talked about focusing on the long term and building a team of great people that are passionate about what they do and take a lot of pride in it. And I feel very strongly that we've done just that. So on the slide you can see right now is all of the VCIM investment management team, which includes our fantastic fixed income portfolio managers and the unbelievable ESG team. And although we're focusing on the equity team today, it's important to understand that, like Lindsay was saying, each of these 3 teams works very closely together so that we can take advantage of each team's inherent strengths. So on the right-hand side of this slide is, of course, the equities team, which has now grown to 5 people, although we're currently actually in the process of adding a 6th full-time member as well as a co-op student for the summer months. So I'll start with a quick introduction of our two associate investment analysts, Riley Hunt and Morgan Ayres, both of whom are going to be speaking shortly. So Riley joined in June of last year. He has about 2 years of experience in the industry, and he previously worked on a global equity fund, having worked his way up from a co-op position at his last shop to a full-time analyst role. And Riley is probably one of the most passionate investors I have ever met. He's also a consummate learner, and he's been doing a fantastic job. And again, I think that over the years, you're going to see him moving up and more into a leadership role. Moving on to Morgan, she joined the team not long after Riley. She has about the same years of experience, but a little more of a varied background. At her last shop, she worked on an ESG team, a global equity team, and a partnership team that oversaw external fund managers and did direct deals. So due to her backgrounds, Morgan started working on our renewable holdings on day one, and she's slowly becoming an expert within that space. So it's fantastic to have someone on the team with that type of experience, and it's very rare to see that much experience in somebody who's so earlier in their career. So again, just a great addition to VCIM. Moving on to Mary Tsang, who is an associate portfolio manager. She is the veteran of the team and has a number of years experience in the financial services industry. Mary actually worked with Jeff Adams at their prior shop, and both Jeff and I understand just how indispensable she is. You know, she has a number of skill sets that are very difficult to find. You know, Mary spends the majority of her time right now working on the global equity fund, but you know, like everyone else, she has just offered valuable insights into each of the funds. Moving on to Charan Sangera, who unfortunately couldn't be here today, but Charan is our most recent addition, and he is a senior associate PM. So when we were hiring for this role, you know, again, Jeff and I were talking, and we wanted to make sure that whoever was the successful candidate, that he or she was vetted by everyone on the team. And we're looking to hire a team here that is hopefully going to be working together for a number of years. So it was of utmost importance that we found the right person and not just the right resume. And I think we did just that. So Charan has over 10 years of experience in the industry, including experience in Canadian equities as a sell-side analyst at RBC, followed by a buy-side role where he worked on a US small cap fund. So I know I speak for the whole team when I say we were really happy that he decided to join us. And finally, just a quick bit about myself. I'm, of course, the portfolio manager of the equity funds. And as I said earlier, I joined Vancity. It's almost 1 year now. Prior to this role, I worked at the BC pension funds, known as BCI, for just over 8 years, and worked in global equities for pretty much the entire duration. In fact, BCI is where I actually met each of Riley, Morgan, and Charan. And although I learned a lot while at BCI, the move to Vancity has been fantastic, and I'm passionate about investing, as is the rest of the equities team. And I think we feel very lucky to be able to do what we do each day. And the nice thing about working at Vancity is it allows us to marry our values with our work, which is just a fantastic feeling. So for now, we're happy with our team and excited to add one more full-time member. But of course, down the road, we'll always consider adding more members if we think it can add value. So turning now to the next slide and looking at the equity markets, it really has been a sharp reversal from what we saw last year. Outside of a couple of major markets, the UK and Canada, pretty much every major market finished the quarter down, with the Euro Stoxx 50, which is a major European index, and the NASDAQ, which is geared to higher growth information technology stocks, both down by more than 9%. The S&P 500 actually had its fastest 10% drop to start a year in more than a decade, although it has improved slightly since that point. And over the first quarter, there was, and there still is, a lot of noise that investors have had to deal with, including rising inflation, increasing interest rates, and of course, the war in Ukraine, you know, all of which have increased the volatility of markets and led to market underperformance. Now, as you can see in the charts on the top right, there is a very major divergence happening in terms of sector performance. Energy, which is almost 16% of the Canadian index, was up almost 30% in the quarter, and it's well ahead of every other sector. I mean, this is really the only reason why Canadian markets ended the quarter positive, because energy is driving the bus. So we're only 3 months into the year, and energy outperformed the worst performing sector, communication services, by almost 40 percentage points. That's just incredible, and it's unlike anything I can remember in my career. And historically, during periods of market stress, investors tend to rotate into high quality growth stocks, but during the market's recent pullback, these characteristics have actually led to underperformance. As you can see in the bottom chart, the value stocks right now are leading the charge by quite a bit. And a lot of that performance is coming from energy, mining, and banks, all of which are very value oriented. And of course, being that we run fossil fuel free growth ESG mandates, this is obviously not ideal, but this type of historical divergence generally doesn't last. And, we're seeing a lot of investors chase what has worked over the past few months. At the same time, most growth companies continue to post strong results. Nothing has fundamentally changed, in terms of their business model or growth profiles. The only change has been to their share price. And over the longer term, we have confidence that being fossil fuel free is the right thing to do for both our planet and our investment returns. However, there are going to be short-term headwinds like we're currently seeing. And we also think that the current situation in Russia is shining even brighter lights on why we need to move away from traditional fossil fuels and more towards renewable energy. So moving on to the next slide, what's important to realize is that there has been no change in terms of the strength of the economy as companies continue to grow earnings at an impressive rate, as you can see in the top line of this chart, which is showing first quarter earnings growth for the S&P 500. So what is happening is that valuations have fallen, which has driven the stock market declines. And this is a good sign, because valuations are driven by investor sentiment, while earnings are a key indication of the strength of the economy. So what this chart is telling us is that nothing structural has changed to the underlying company's growth rates. Instead, the market downturn is driven by investor sentiment, which can easily reverse course. And this next chart is a perfect example of how an average investor reacts over a market cycle. It really isn't natural, I guess, for people to act rationally while watching the stock market. We have such a fear of regrets and loss avoidance that we do almost the exact opposite of what's best for us. We sell during market bottoms, which is described in this chart as the point of maximum fear, and we purchase during market tops, which is actually the point of maximum risk. And I heard a really good quote once: nothing looks cheaper than a stock that is going up, and it is very true. We love to watch stocks go straight up, and we tend to have regret that we don't own more, while watching a stock go down terrifies us, and we just wish that we didn't own it at all. So it's fighting these inherent biases that is really one of the most difficult but important aspects of investing. And this next chart is a very good visualization of how our team thinks about stock market returns over different time periods. As I said earlier, short-term price movements, as you can see on the left-hand side, are entirely driven by investor sentiment, which is exactly what we saw in Q1. Nothing has fundamentally shifted over the past 3 months with regards to the businesses themselves, but prices have fallen quite dramatically in many cases. It isn't until we get out to 5+ years that the market becomes more of a weighing machine and rewards high-quality companies systematically. And investors that try to invest based on what they believe sentiment will be, they can do well for a period of time, but similar to a hot hand in the casino, it just doesn't last forever. There are too many unknowable market events that drive sentiments, as we're seeing right now. And even if you do have a crystal ball, you still have to guess what the market reaction will be to these events. Personally, I never would have guessed that in March 2020, when the pandemic was first coming to light and the long-term effects at the time were very unknown, that the market would reverse course so quickly and turn into a full-on bull market. I've actually often found that the reaction by the equity market to major macro events, it's generally irrational and nothing like you would ever expect. So for us, instead of focusing on what we think investor sentiments will be, we focus on our process of investing in high quality companies that we can own for the next 5+ years, and then look to sit back and allow the power of compounding to do its work. And with that, I will pass it on to Mary.
Great, thanks, Mark. So what I'll be highlighting today is that drawdowns are actually a natural part of the market. In fact, the recent movements are not close to unprecedented territory. So over the last 100 years, give or take, market has experienced a 10% or more drawdown almost 2/3 of the time. And yet despite this, the market ends the year in positive territory 70% of the time. In fact, bear markets, which is when the markets fall by 20% or more, happen once every 4 years. And market crashes, which occurs when there is a decline of 30% or more, happens about once every 10 years. And looking at 2021, the biggest drawdown the market had was about 5%. But that kind of tranquility is not the norm here. Last year stands out from a historical standpoint, while this year is par for the course. It had been nearly 22 months since the index last experienced a correction, making a 10% drawdown actually long overdue. The following slide shows the maximum intra-year equity market drawdown going all the way back to 1980. Over this period, we saw a double-digit pullback a little more than half of the time. There was a pullback in every single year with an average decline of 13%, but markets still averaged a 9% gain per annum over this period. And in the years that market experienced a double-digit pullback, it ended with a positive return 62% of the time. At times like this, it's important for us to ask ourselves this question. How have the markets typically responded to these events throughout history? By answering this question, it helps us better understand how to react and keep our emotions in check. The chart on the next slide illustrates that market performance typically rebounds quite strongly following drawdown periods. So on average, the S&P 500 has been up by nearly 14% in the subsequent 3-month period and up more than 27% over the next 12 months following non-bear market price correction. The goal for most investors is to hold on long enough to benefit from these rebounds and to avoid trying to time the market. And the next slide really drives this point home. What it is showing is that trying to time the market makes actually little sense. Over this 20-year period, the market returned 9.4% per annum, but simply missing out on the 10 best days would have almost cut returns in half. Missing the top 30 days reduced that return to below 1%, and even worse, missing the top 40 days resulted in a negative loss over this period. So what does it all mean? In short, it wasn't the timing, it was the time in the market that mattered. But what about if someone is able to perfectly time the market? Well, the chart on the next slide answers that exact question. So what this is a study that took 5 different investors, each of whom received $2,000 every year over a 20-year period to invest in the market. The first bar here is an illustration of a person that invested the money at the lowest possible point of each year, which is what most market timers are desperately trying to do. But even in this case, the overall return difference was minimal to someone who was simply invested the whole amount on day 1, which is the second bar here. Even investors that did terribly in terms of their timing, which means that they invested at the market peak each year, still came out okay at the end. The investor that did substantially worse was the one who stayed in cash investments over the period. So the lesson here is procrastination is worse than bad timing. And long term, it is nearly always better to be invested than not invest at all. And moving on to the next slide. And unfortunately, the average investors don't realize this, so they tend to underperform the market. As you can see here, despite strong index returns over time, the average investor has underperformed a basic indexed 60-40 portfolio by about 3.5% on an annualized basis. Now, on a $100,000 initial investment from the start of 2001 through the end of 2020, that actually adds up to nearly $170,000 worth of missed gains. The problem is that investors are human, and at the end of the day, humans are emotional beings and are therefore easily persuaded, especially when it comes with the expectation that an action will allow them to avoid a loss. And because of this, many investors will continue to try and time the market, which, as we have seen here, has real costs associated with it. And with that, I'll pass it over to Riley.
Thanks, Mary. So this next chart shows the cumulative market returns over the last 40 years in the US, Canada, and globally. And what's really interesting is that if you just look at the performance, you'd think, well, that was a great time to invest over the last 40 years. as returns have been really, really strong. But what happens when you zoom out is that every 10-year period has been filled with some combination of a reason not to invest. And that could include some things like wars, recessions in 2008, 2009, a bank crisis, major political events, terrorism. And if you expand that another couple of years, you would have seen a pandemic, another war, and now we're currently dealing with inflation, interest rates again. And all these events have resulted in short-term market sell-offs. But what's interesting is that those who have stayed invested were rewarded with continued compounding and exceptional returns, despite upwards of 40, 50 different reasons not to invest. So another point we'd like to make is that it's really easy to use hindsight bias and say that each of these events was a great buying opportunity. But when you're in the middle of it, it really, really doesn't feel that way. And for myself, like I've only been in my career for 2 to 3 years now, and I'm really starting to understand that the mentality when you're in the moment is much different than looking back on these events. And so for me, the COVID pandemic has been a really good insight, and now going through a period of inflation and interest rates, as well as the war in Ukraine, has been a great insight as well. And I think, you never know with foresight, but I think if we look back 5 years from now, we're probably going to say that a lot of these events we're going through are going to be blips in the long-term performance of equity markets. And I just think it's really important to drive home that to get this fantastic return over the past 40 years, you would have had to endure a lot of difficult times without jumping in and out of the market. And then just one last point on this chart, and kind of put a positive spin on it, is what stands out to me is that there will always be the next thing. There'll always be the next event. There'll always be the next recession, the next banking crisis, et cetera. And as humans, we never want to see these events occur because a lot of them are quite tragic, including war. But the reality is that they'll likely continue to happen. And what that provides us as investors is the opportunity to take advantage of a dislocation between the value of a great business and the price of a good business. And we like to think that over the last six to 12 months that we've taken advantage the best we can to ensure that the long-term returns of our portfolios are at the highest they can possibly be. So this next chart shows the historical performance of the S&P 500 throughout all of the US bull and bear markets since 1942. And what we really think is it helps visualize the dominance of bull markets relative to bear markets, both in size and duration. So just a couple points that aren't stated in the chart, but that helps support our view. During this period, the average bull market lasted nearly 4.5 years and had an average cumulative total return of almost 155%, while on the downside, the average bear market lasted only 11 months and had an average cumulative loss of just 32%. And so what that shows, that's a quite a large difference, both in the size and duration, and shows that you need to endure the short-term bear markets to gain from long-term duration bull markets. And just as a general statement on the slide, the market is positive approximately 70% of the time. But what's interesting is that investors really tend to focus on the 30% of the time that it's negative. And it's in that 30% of the time when investors make the mistake of removing themselves from the markets, only to miss out on a good portion of the 70%. For us, this is just a great example of market timing, which is, in our view, nearly impossible. And we spend little to no time trying to execute any sort of market timing strategy. And then switching to current events, there's obviously a lot of discussion surrounding the Russia-Ukraine war right now and what the implications are for the equity markets. And I think just first off, we really want to make light of what is occurring in Ukraine as I think we'd all agree that the lives lost are far more important than the direction or the volatility in the stock market. And so there's far more important things than investment returns in these scenarios. But we also think our job is incrementally important during these times. And it's important to provide some context in terms of what's happened historically in times like these. And so if you look at this table, there's a long list of notable geopolitical conflicts going back to the late 60s and the resulting market performance. And I think it's important to understand that not all two events are the same. And so to suggest that the Ukraine-Russia war is going to have a similar impact to something like the Soviet invasion of Afghanistan is probably naive. But it is interesting to see that the average drawdown of the S&P 500 was just under 5% and took only 43 days to recover. And so what this tells us is that the market typically holds up quite well during geopolitical shocks, and any price weakness resulting from these events tends to be quite short-lived. And this, just lastly for me, I think something on top of mind for a lot of investors is the rising interest rate environment and how that will impact equity markets. And I think, just to start, if you look at the wide range of forecasts within the economic community, whether it's you flip on BNN or Bloomberg or read the local newspaper, I think that wide range is kind of confirmation that the future is very unknown. And in the same way that market timing is an impossible exercise, I think so is timing the interest rate environment. But we think looking at what has happened to equity markets during previous tightening cycles is probably the best way to think about how the current tightening cycle is going to impact equity markets. And as you can see in this chart, the results are actually quite good with positive performance prior to and post the initial hike of the last 4 cycles. And a big reason why we think that is due to the fact that markets generally sell off into the first rate hike because the market anticipates the duration and severity of rate hikes. This is important to understand because removing oneself from the market during the early stages of the tightening cycle can mean missing out when the market recovers. And I really want to reiterate once again that it's the investors that hold on during the downturn that will eventually reap the rewards. And then just lastly, and I think this is core to our investment philosophy, which Morgan's going to touch on in a second, but another reason we believe equities perform well around rate hikes is that although higher rates increase the opportunity cost of owning equities, the underlying businesses are largely unchanged. And our view on inflation, which is generally a driver of rate hike decisions, is that great businesses have pricing power and are able to raise prices with inflation and in some cases actually expand margins. And so I'll leave it there and I'll pass it on to Morgan, who's going to touch on our investment process and our investment philosophy.
Great, thanks, Riley. So next we wanted to touch on our investment process at a high level to give everyone a basic understanding of how we go about making the decision to invest in a company. And at the end of the day, our process is designed to help us find high quality growth companies that we can hold for 5 to 10 years. And although what you see here is quite simplified, there is more to the process. But the 3 main categories that we are looking at largely encompass everything that we are looking for. This includes attractiveness of the industry that the company operates in, the competitive advantages of the company, and of course, management quality. And of course, all this is encapsulated by our ESG analysis. Within each of these main categories, there are subcategories that help us paint a picture of if there's enough evidence of what we're looking for in a company. So our analysis starts at the industry level, and this is because this is where most advantages are born out of. And overall, what we're looking for is an industry with a positive long-term outlook, high barriers to entry, and good competitive dynamics. A really good example of companies that have a good industry would be Visa and MasterCard. They both operate in a high growth industry that is dominated by a few major players and has a very long runway for growth as the world moves towards a cashless society. Now, after that, we look to identify the company's competitive advantage. In other words, what does the company do to protect itself from competition? And this part can be quite difficult in understanding what stage the advantage is actually in. For example, I would say Coca-Cola has a very strong brand advantage, as almost anyone in the world could recognize that famous red can, but it's a very mature advantage with little growth runway left. The next thing that we look at is to assess management, and this includes understanding a company's culture, as this can have a massive influence on a company's ability to thrive. Think about a positive culture drives happier employees who tend to be more productive, which will help create value over the long term. Of course, we're also looking at shareholder alignment and proper governance, and having a very strong ESG team is a huge benefit here. In terms of valuation, it tends to be more of an art than a science, but essentially all we're trying to do is to make sure that we aren't overpaying for these companies. And there's various tools that we can use to analyze that. Now, putting this into practice on the next slide. A good example of a company that fits our process very well is Costco. This is a name that we hold in our global equity fund. Costco is, of course, the leading low-cost retailer and utilizes a membership format where you pay an annual fee to be able to shop at the stores. And the first thing that you have to realize about the industry that Costco operates in is that it's very hard to differentiate yourself. Essentially, everyone in this industry is selling the same product. And so to compete in this market, you actually compete on price, or it's known as a commoditized industry. And this is something that the founders of Costco realized from day one. They understood that if they could keep their operating costs low, hence the warehouse look, and buy in bulk, they would be able to offer the lowest prices possible and attract more shoppers. And by doing this, they made it very, very difficult for peers to compete with them. Every time they open a new store and grow their membership base, they're effectively reinforcing that advantage, and it gives them more purchasing power with suppliers, which allows them to further decrease their prices, which grows that price advantage that we're looking for against peers and leads to further membership growth. And then the cycle keeps going. And now from the customer's perspective, the membership price is almost an afterthought. It takes something like 3 or 4 trips to Costco for the membership to be paid off based on the cost savings that the member receives. And because of this, Costco can raise their prices of their memberships every 4 to 5 years with no impact on total members. It's essentially the perfect flywheel effect. And management understands this effect very, very well and is obsessed with passing on any savings that they receive from suppliers to their customers. This is also the reason that the cost of a hot dog at Costco hasn't changed from its initial price of $1.50, which was introduced in 1985. In fact, there's actually a very well-known story about a manager who looked to raise the price of a hot dog by 25 cents, and this was met with some very, very foul language by one of the founders. And because of this, they actually decided to vertically integrate and build their own plant to produce hot dogs and lower the cost and essentially continue selling them at $1.50, which is a very strong dedication to a low-cost strategy. And I'm not really sure of any other retailer who would be willing to do that. And it's this dedication and reinvestment back into this company's advantage that gives us the comfort that no matter what happens over the next several years, the advantage will continue to get stronger and provide more and more protection against both competition and difficult macro events. Now, part of our process also involves a constant search for opportunities to improve the overall quality and potential returns of our portfolios. And we can do that in one of 2 ways, either through increasing the weight of our current holdings or adding new companies. And the best opportunities to do this actually comes during market volatility or markets that are in a downward trajectory, both of which we're seeing right now as investors sell off their high quality companies. And it's in markets like this where investors can dramatically improve their future returns, which is exactly what we're doing. And if you look specifically at our global equity fund, you've seen a material fall in valuation from the portfolio year to date, as you can see on the graph on the left-hand side. At the same time, returns have improved after strong earnings seasons for most of our holdings, which means that our portfolio now consists of companies that trade at a lower valuation but have a higher return profiles. And all of this is happening while nothing structural has actually changed in most of our holdings. They're on track to hit our internal targets, which on average means low double-digit top-line growth for the next 5 years and mid to high double-digit earning growth. So what we've been doing is pushing weight into our higher conviction names in order to take advantage of the fear in the market. And as a result, the expected returns on our funds, as you can see, defined by ROE in the chart, has moved higher than what it was a few months ago. In addition to this, for each of our 3 funds, we keep a watch list of companies, which includes very high quality businesses that passed our investment process, except for the valuation component. And the opportunity to add names to our funds from these watch lists has increased as the market has fallen. On average, companies on the global watch list are down more than 20% from their 52-week highs, as prices have fallen almost 14% year to date. And although here we're only highlighting our global fund, the same holds true for our Canadian equity funds. Essentially, what we're trying to highlight here is that volatility and market drawdowns are a friend of the long-term investor. And we're making sure that we're taking advantage of it by continuing to focus on improving our holdings at any chance that we get. And now we're going to shift gears just a little bit, and we wanted to add in this next chart as it highlights the importance of having a financial advisor. What this chart is showing is the difference in wealth accumulation between households that have a financial advisor and those that don't, based on a study that was done a few years ago. The research shows that households that have an advisor save twice the rate compared to those who don't. And what's moreover, over the long term, it's almost a 4 times advantage, which is huge. Basically, financial advisors help people increase their wealth, and the longer people have advice, the more their investments can grow. And a big part of this is because advisors help clients navigate the difficult periods where returns are negative by ensuring that people stay invested. And finally, we wanted to finish off this presentation with this quote. So compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. Everything comes back to this simple idea. Compounded returns are an investor's best friend. Once people realize the power of compounding, everything else that we've touched on today really falls into place. And in a world that's increasingly geared towards short-termism and instant gratification, there's a huge advantage to be gained by those who move in the opposite direction. Just think about all those unchecked impulses that can ruin investors' return. For example, the tendency to trade too frequently, making emotional decisions based off of alarming news stories, to dump funds that have lagged for a year or two, or to sell that winning stock prematurely instead of letting them compound. The ability to resist such an urge is one of those really big superpowers. And with that, I'll hand it back to Lindsay.
Thank you so much, Morgan. And thank you everyone for all of that incredible information. I loved all the quotes. And I'm especially happy to hear, Morgan, that one of my guilty pleasures, which is a hot dog at Costco after I've purchased a month's worth of food for my family, is not going up anytime soon. So now we're going to turn it over to the Q&A portion of our presentation. And we have everyone who has presented on here with us, as well as Edmund Ho from our ESG team and Wes Dearborn, who's one of our fixed income portfolio managers here to answer any questions. So please type in your questions to the chat box. The first question we have, I think, is for Edmund, and maybe Mark, you can chime in as well. But Edmund, how do the equities team and the ESG teams, how do they work together collaboratively?
Yeah, I would like to speak on that. So we take an integrated approach, and basically we approach the same name and research from two different angles. So Mark's team, being an equity team, they would look at a company from a financial standpoint. And my team, headed by Kelly Hirsch, we do the research from an ESG angle. So how this kind of works in practice is when the equity team kind of comes up with a name, they would sort of pass it on to us for a pre-screen to make sure that it's not part of the exclusionary list. And we don't just look at it from the surface of saying like, hey, this company is involved directly in this industry. We also look in terms of, it's more of a nuanced approach. We look in terms of what else they might be involved in. So rather than just direct exposure, it's also indirect exposure and possible reputational risk regarding this company. And then once we have an idea from the pre-screen process, we let the equity team know, who then will go off and do a more in-depth research into your traditional fundamental analysis. And that's not where we end as well. So once we hand that decision off to them, we go and do an in-depth ESG look into the company. And then we present them with our research, and then together we decide that the company should be added to the portfolio. So once the name is also included in the portfolio, that's the conversation continues on. Sometimes we take a very active approach in terms of engaging with companies, trying to steer them into ways that we want them to change. And then there's an active dialogue between our team and the equity teams to sort of steer the management conversation, engagements on our side, engagements on their side. And so that way it allows us to dedicate the resources to look at both parts of the company and have a holistic view of what we're exactly investing in.
Great, thank you, Edmund. Mark, anything to add?
Yeah, maybe just a couple points, although Edmund kind of hit on everything. I mean, I would say that it's very important for all of our teams to work together. I'm never going to be as strong as Kelly is in terms of, analyze a company from an ESG lens, but, we're trying to learn from one another, and we want the teams to collaborate. So we don't just want us sending names to the ESG team and then they send us back an analysis. Like, we want to have a discussion. We're here to analyze, not just box check. So we have a lot of meetings with one another. It's tough with work from home right now, but Kelly and I had a standing meeting, and we just want to get a better grasp of how each team kind of looks at a company and how we analyze it, so that we can fully take the financial analysis and the ESG analysis and make it one, which I think will improve not only our investment returns, but also decrease the potential risks out there.
Thank you so much, Mark. And I do think it's something that's unique to VCIM. You don't see the integration between the equities and the fixed income and the ESG teams as close and collaboratively as you do at VCIM. So our next question is for Wes. A recession can follow an inverted yield curve up to 2 to 3 years later. Can you provide your thoughts on the potential inverted yield curve and recession, and specifically how to construct an investment portfolio in this environment?
Thank you, Lindsay. That is a topical question, given the flattening we've seen in the yield curve here in Canada and the US over the last couple months. Most of the flattening that we've seen is driven by the fact that rate expectations from the central banks, the Bank of Canada and US Federal Reserve, rate expectations have really ramped up higher. So pricing in the bond market for expectations of this tightening has gone up, and that's driven short yields higher and quicker than mid and longer date yields have. In regards to the inverted yield curve, specifically this relates to the 2s 10s, so the 2-year 10-year curve that we see in the US and Canada. And historically, this has given off indications, leading indications that a recession is due to follow. And when the curve, US 2s 10s, for example, has inverted in the past, we have seen recessions follow 1-2 years down the road. Essentially what the market is signaling, yields looking out further out the curve typically have a risk premium in it, and the longer you invest, the higher the yield in a normal environment would be. When the yield curve inverts, when the 10-year yield becomes lower than the 2-year yield, essentially the market is saying there's something going on here, and we think that this is going to cause a slowdown at some point in the future. So what we're seeing now is that the market, the bond market, with the US 10-year, it did briefly trade below the 2-year yield at the beginning of this month, but just only for a week. But the market, what it's suggesting at that point was that if the US Federal Reserve continues to tighten its policy rate at the expected pace, and this is the market's expected pace, that it's going to cause a slowdown at some point in the future. It could be a year out, 2 years, 3 years out. The signal that we got 2 weeks ago with the inversion in the US curve, it happened much sooner than it has in previous cycles. And this is just due to the fact that the market's pricing in a very quick pace for the US Federal Reserve to tighten its policy. And that's back on the back of higher inflation that we're seeing in the US, Canada, and across the globe. Now, when we look at the Canadian yield curve, we have seen some inversions further out the curve, but the specific 2s 10s curve has not inverted. So the signals that we have seen, it's not necessarily meaning that a recession in the US is going to happen imminently, but it's a warning sign that, you know, if rate hikes do happen as quick as they might over the next year, we could see a slowdown in the economy. In terms of the, you know, bond holdings and the bond portfolios that we manage, typically when we head into a slowdown in the economy, you see the yield curve flatten, and we have seen that happen, but it hasn't fully inverted. And at times of flattening and slowdown, typically we will shift on the yield curve and move more into a bullet position as opposed to a barbell. So we have started to shift a little bit, but that's a bit of a defensive positioning. And in addition, which we haven't done yet, but if we do expect the economy to slow down, and it's always hard to predict a recession, but if we do expect an economy to slow down, we will go do more defensive in terms of our holdings. So reducing our overweight and positioning corporate bonds and going more to defensive high grade government bond funds within the bond funds. From there, I will pass it on to Marc to touch on what he would do in the equity funds if he expected growth slowdown in the Canadian and US markets.
Yeah, thanks, Wes. So, I mean, to be honest, we kind of stick to our process in almost any type of market. It's impossible to really know what's going to happen from a macro standpoint. You know, predicting recessions, predicting value versus growth, it's just not, there's nobody that's able to do it, or at least able to do it consistently. So we're going to stick to our process of investing in, you know, high quality growth companies that we can own for 5+ years. And what we're trying to do is build an all-weather fund as best we can, which means that no matter what the market throws at us, that we're going to be able to kind of weather the storm. And in our opinion, you know, investing in companies that have pricing power, as we touched on earlier, that have a strong balance sheet, that have good management, that think long term, that's the best we can do to weather through, you know, inflationary periods or periods where value is outperforming. Obviously, there's certain times, like when energy is doing quite well, that no matter what our process does, we're not going to be able to keep up because we are fossil fuel free. But We think the best thing to do is to stick to our process and to not try to guess the unguessable.
Thank you, Mark, and thank you, Wes. Another very topical question. What are we doing about our holdings in the banks that lend to the fossil fuel industry and other areas like Russia or weapons? I think Edmund, if you could tackle this one.
Yeah, absolutely. Yeah, you're right, Lindsay. That's a very topical question, and one that we've been asked in the past month in a few variations of it. So I'll speak to the weapons and the Russia part first. So as I mentioned before, my last answer, I alluded to an exclusionary list. So weapons and direct manufacturers of armaments fall within that exclusion list. So right away, any company that are involved in that operation, we simply, it's not part of an investment universe, and so we don't have any holdings in that. As it comes to Russia, at the onset of the Russia and Ukraine conflict, we did do an assessment on our portfolio to see if there were any direct exposure or indirect exposure to both Russian companies as well as companies that operate significantly or derive a significant part of the revenue from Russia. And our finding was that we don't actually have any exposures there. So I think that sort of reflects the soundness of our process, that we were able to avoid companies that were sort of questionable. As many of you are aware, seeing the news, a lot of the other funds weren't as lucky, and there are still, to this day, they're holding Russian assets that are questionable in value, and they became untradeable almost overnight. So we're glad that we're not in that bucket. And yeah, again, that kind of sort of speaks to the soundness of our process. As it comes to the first part of the question about banks lending to the fossil fuel industry, that's a little bit more tricky because we understand that it's in Canada, it's difficult for the banks to say they're not going to lend to the fossil fuel industry, simply because the fossil industry still is a big chunk of the economy of Alberta. And for the banks to do that, it would basically, they run to the risk of alienating a big chunk of their client base. But we here at VCIM are very climate conscious, and certainly that is a concern for us, and we're trying to do everything that we can to steer them to change. But we also understand, given the size of the banks, it's changes like this does not happen overnight. It's like, as Kelly would usually say, it's like turning a large freighter around. You sort of need to build momentum from it. And so one of the things that I would highlight is, like, for the last year, we take a very active approach in terms of engagement and having dialogues with the banks. And we're also part of an informal Canadian banks working group with other like-minded investors whose agenda is to engage and coordinate in climate-related matters and engagement. So, like, one of the ways that we had in the past year was we were able to influence TD Bank and Scotiabank to put on a ban on Arctic oil and gas project financing. And the way that we see fossil fuel financing, it's the same approach. We're going to have continued dialogues with them. We're going to make our voices heard through proxy voting. The only way to put ourselves in a situation where we can make our voices heard is actually to retain some of the holdings. If we were to divest in it, we simply would lose that avenue of dialogue. So that's sort of our approach.
Thank you very much, Edmund. And I think we have time for one last question. And I will turn it to someone on the equities team. How about Riley for this one? What gives the VCIM team confidence in wealth creation and protection during this period of volatility?
Yeah, thanks, Lindsay. And I'm going to change the question a little bit because I think it's more important actually to take this from the view of the client. So for clients, why should they have confidence in us that we can deliver market performance in a volatile period? For us, like, one of the things we have in our checklist when we look at a company is the management team that we're investing alongside, are they aligned with us as investors? And I think the same sort of structure holds true with clients. Is that the first question I would ask an investment management team is, are you aligned with me as a client? And I don't want to speak for everyone on our team, although I think everyone has some level of alignment and some level of their net worth invested. But for myself, pretty much the majority of my net worth is invested in our funds. Actually, I think my dad's actually listening in. He's now a client, so I've transferred him over. So within my family, there's certainly an alignment of incentives, and I think that should give them confidence right away, because we have just the same opportunity set as everyone else in this call. I mean, I could go buy an S&P 500 ETF tomorrow if I wanted to, but for me, I believe strongly in the process that Marc alluded to earlier and that Morgan walked you guys through, and that is buying the highest quality companies in the world. And whether interest rates go to 3% or 4%, that doesn't really dissuade us, to be honest. I mean, owning shares in a company like Google, which is one of the best business models ever created, and having the ability to basically free ride the success of their management team and what they've done. And I could go on and on about different examples of companies, but that's what gives us a lot of confidence, to be honest. And when you go through periods like we've seen with volatility, what we talk about internally is increasing the long-term IRR, internal rate of return on our funds. And what that means is that when there's a dislocation between the whole market selling off along with high quality companies, we have the ability to increase the portfolio weight of our highest conviction ideas and buy companies that otherwise maybe would have fallen outside of our valuation parameters. But when they fall off a cliff along with the rest of the market, it allows us to go buy them. And I mean, you could research some of the best investors in the world, and they've all taken that approach, whether it's Buffett buying Coca-Cola back in the day and some of the investments that they've made. And that's what gives me confidence. And I think confidence should be portrayed in one's alignment with incentives. And we're, as a team, we're very, very much aligned with all our clients in the call.
Awesome. Thank you so much, Riley. And I definitely think that speaks to the conviction that the whole team has in the process and in what we're doing here at VCIM. So on behalf of the whole team, I would like to thank Marc, Riley, Mary, Morgan, Wes, and Edmund for the presentation, for the information, and for the great work that you do for our clients on a daily basis. And we want to thank you, our valued clients and members, for being here today. We hope it was informative. We'd also love to hear your feedback so we can improve the information that we're providing to you. Like I mentioned at the beginning of the presentation, we've recorded the session. We'll be sending out a link with the recording and also with a survey. Please send us your feedback. We want to make sure that we're delivering the right information to you. And the finest form of flattery is sharing. So if you've enjoyed the session, feel free to share the link to anyone who you think would be interested in the information or in hearing about our services. So please reach out. Again, thank you to everyone and have a lovely rest of your day.